Hey everyone, and welcome. Today we're diving into a really fascinating part of the stock market, one that a lot of investors see as a key to, well, accelerating their wealth. We're talking about mid-cap stocks. So if you've ever thought about how to add a little more horsepower to your portfolio, you're in the right place.
You can think of the stock market like a big garage full of motorcycles. You've got your heavy, stable cruisers. Those are kind of like your large cap stocks. And then you have this, a powerful, agile, high-performance machine. And that right there, that's the perfect way to think about mid-caps. They promise this thrilling speed and incredible growth, but they also demand skill and, let's be honest, a healthy respect for the risks. So let's get into it.
Okay, so before we even think about hitting the throttle, we really need to understand what kind of machine we're dealing with. So what exactly is a mid-cap stock, and where does it fit in the whole market picture?
This visual is a great way to see it. Picture the entire universe of stocks. Up at the top, you've got the large caps, the established giants, the household names. Way down at the bottom, you have the small caps. They're nimble, full of raw potential. And right there, smack in the middle, that's the sweet spot. That's our focus, the mid-caps. They are the critical bridge between those two worlds.
So let's talk numbers for a second. What does mid actually mean? Well, a mid-cap company has a specific market value. We're talking about companies that are valued roughly between, say, 34,000 and 104,000 crore rupees. So they're not startups anymore, they've proven themselves, but they still have a ton of room to grow.
And that brings us right to the heart of the matter. Because with that potential for higher speed comes higher risk. Understanding this balance, this trade-off, is absolutely the key to investing in mid-caps successfully.
And let's be really clear about that risk. This is the official riskometer, and you can see it's rated very high. Now, this isn't something to just gloss over. It means you have to expect some pretty significant price swings, what we call volatility. This is the skill part of handling that powerful motorcycle we were just talking about.
This really lays out the core trade-off perfectly. With large caps, what you're really buying is stability and leadership. But with mid-caps, you're investing in potential. The whole game is to find those companies that are on that explosive growth path, the ones that could, just maybe, become the giants of tomorrow. And that's where the real reward comes from.
So we've talked about the theory of risk and reward, but what has happened in the real world? Let's dig into the data and see how this whole dynamic has actually played out over the years.
If you zoom out and just take a really long-term view, the story is pretty compelling. Over a 15-year stretch, the mid-cap index delivered an annualized return of almost 15%, and that clearly outperformed the large-cap index. It just goes to show you that even with the short-term bumps, that higher growth potential has historically led to higher long-term returns. But, and this is a huge but, that long-term average hides a really bumpy ride. I mean, just look at this. In 2007, a phenomenal year, mid-caps shot up over 77%. But the very next year, 2008, they crashed by nearly 65%. This is that volatility we've been talking about. The highs are higher, for sure, but the lows are definitely lower.
So what's the big takeaway from all this data? Well, this quote really sums it up perfectly. Despite all that volatility, mid-caps do have a track record of outperforming, especially when the economy is bouncing back and growing. They really act like a powerful engine during the good times.
So you can see that navigating this kind of space requires a really clear strategy. So how does a fund like the Trustmf Mid-Cap Fund decide which companies to actually put their money into? Let's take a look at their playbook. Okay, so this is their secret sauce. It's called the LIM framework. You can think of it as a set of 3 lenses they use to find the most promising companies. They're not just looking at this quarter's profits. They're trying to figure out a company's total worth over its entire future, what they call its terminal value.
Let's break that down real quick. L is for leadership. They're looking for solid management teams because great leaders build businesses that last. I is for intangibles. This is the cool stuff that doesn't always show up on a balance sheet, like a powerful brand or unique technology. And M is for megatrends. They want to find companies that are set up to ride these huge waves of economic change because, hey, it's a lot easier than swimming against the current.
So the whole process is pretty straightforward, but it's really disciplined. It all starts with the classic financial homework, digging into the fundamentals. Then, they run everything through their unique LIM framework as a filter, and the result, they believe, is a portfolio of really carefully chosen mid-cap companies that have the best shot at long-term growth. All right, we've looked at the machine, we've talked about the risks, we've seen the historical performance, and we've gone through the strategy. Now for what is maybe the most important question of all. Is this type of investment the right ride for you?
So let's run through a quick checklist. Just ask yourself these questions. First, do you have a long time horizon? We're talking at least 5 years to ride out all the bumps. Second, are you genuinely okay with the idea of sharp downturns in exchange for that higher growth potential? And finally, are you a disciplined investor? The kind of person who can stick to a plan, like a systematic investment plan or SIP, where you invest a fixed amount regularly even when the market gets really choppy. If you're nodding your head yes to these, then mid-caps could be a really powerful part of your portfolio.
Ultimately, it really all boils down to this one question. For you, personally, is the potential to turbocharge your returns worth the price of admission, which is, of course, the inevitable volatility of the ride? That's the question to think about. Thanks for tuning in.